Ladies and gentlemen, greetings. 2023 is a year full of surprises. The war in Israel and Gaza, the superconductor from Korea, and the persistent inflation in the United States. All of it creates so much uncertainties and risk for all of us. But as the old one says, when there is risk, there is opportunity, and one of which is US Treasury. And we're going to make a lot of money if you follow my procedures. So here's the content we're going to discuss today. First of all, we will introduce you what exactly is US Treasury, where it does, how to work, and what kind of factor influence the price. And then the historical data about CPI, inflation, and interest rate, how they interact and influence each other, the possible risk associated with this investment, and the potential loss, potential gain from this investment. And finally, a little summary of what we did today. So before we continue, I want to warn you that all things we see and touch in this life has risk associated with it. All individuals should be responsible for their own financial decision, financial gain and financial loss. It is very recommended or strongly recommended that we all do our research before making those decisions. So before we introduce the US Treasury script, let's talk about US Treasury first. So US Treasury is issued by Department of Treasury in the United States. It is government officials that borrow monies from citizens and overseas investor. And in exchange of borrowing money, they will give back you the coupon payment and the principal at the maturity date. Due to extremely superior and powerful military power and financial status the United States currently hold, their asset is viewed as AAA class, who is very safe and very liquid, which means you can sell these very quickly to almost everybody in all kind of nations. One thing about these US Treasury script is that their price changes dramatically when certain factors change, especially the interest rate. Show what I mean. We got the data from the, let me see. We got the data from E-Trade, US platform where you can buy and sell all kind of investment you like, such as stock, option, bond, CD, ETF, whatever that is. And we're going to use the data right here. For example, this is a US Treasury script. They mature in around like 30 years, and they currently sell for $294. The yield to maturity is 4.174. And here's the US Treasury bond we're going to use. They mature around the same date, around 30 years, and their current price is 966 with yield to maturity 4.32. Now, to compare the difference between US Treasury and Treasury script, we're going to use the data we just found from here, and then we plug in all the numbers down into financial calculator, where it has present value, future value, coupon payment, interest rate, and maturity date. Pay attention that if you want to do the same exact calculation, you need to add the negative sign. Otherwise, the calculator is unable to identify the correct amount. So we plug in all the data down, and then we got a present value, which is 966 for the Treasury, and plugging all the value down, we got 293. Basically, pretty much the same here. Yeah, pretty much the same. 294.67, 293, yes, 1% difference. Now, what is the difference if the interest rate drop? And as you can see that if the interest rate dropped by 1%, present value of US Treasury only goes up by 19%. But for Treasury script, if their interest rate dropped by 1%, their value actually goes up by 40%. That's a huge 100% gain compared to this one. So we see the reason why I'm picking the US Treasury stripped, because if the interest rate drop or change, his gain will be much more higher than the US Treasury with coupon payment. To show what I mean, I got a graph here. As you can see, this is US Treasury, Treasury stripped right here. So the original price is 966. If interest rate drop by 1%, the present value only goes up by 19%. But for Treasury stripped, if the interest rate drop by 1%, their value goes up by actually 40.5%. That's more than 1 times. Now, the maturity of these Treasury also matters. So to show you what I mean, I still got the data from E-Trade, but this time I changed the maturity to 20 years and 10 years. And as you can see, if we lower the maturity date, their value actually goes up a little bit to 441. Lower to 10 years, it goes to 664. Now, we got the data right here. Assume that we drop the interest rate on each of them by 1%. As you can see, the result for 30 years, the longest maturity, their present value goes up by around 33%. For the 20-year, it goes up only by 21%. And for 10 years, only by 10%. As you can see, maturity also matters to the Treasury. The longer it is, the more change the value, and the more the effect of interest rate would do to their value, present value, I would say. And here's the graph to show you what I mean. So 10-year, 20-year, and 30-year, as you can see, only drop interest rate by 1% will influence the 10-year Treasury by increase the value by 10%. For 20 years, it increased the value by 21%. And for 30-year, it goes up by 33%. So that means that if we want to take benefits and we want to take this opportunity from interest rate changes or interest rate drop, we want to buy US Treasury that has longest maturity with no coupon payment in order to gain the maximum profit. But people may argue that all of this is established on one thing, the Federal Reserve will actually drop the interest rate. And yes, if the Federal Reserve do not drop the interest rate, this entire investment will not work. But to show you why I chose this investment, here is the CPI from the official data. As you can see, the recent years really a tough year to all of us. For example, the let's see, 2022, the inflation is actually 8.9% on June. But with the effort of Federal Reserve that increased the interest rate, after 1 year, the inflation is actually under control, dropped to 3.1%. Although it has the persistent signs on recent periods, such as 3.3, 3.7, but we can see it's actually dropping. And in 2024, the CPI might actually stay around 3%, which is good news for Federal Reserve, since the pressure from inflation is under control, they can drop the interest rate pretty freely. And to show the relationship between interest rate and the consumer price index, which is inflation. Here's the past 70 years data we have. As you can see, this is the gray area will be recession. So 2020, we got COVID-19, 2008, housing bubble, 2000, we got dot-com bubble, and 1980, we got a Volcker shock. As you can see, they usually, for the interest rate and CPI or inflation, they usually move in the same direction, but usually the interest rate move first, goes up, and then cause the inflation to goes down, and then the interest rate will follow the same direction. As you can see, this is up and inflation's down, so this is also up, down. And right here it goes up, this is down, and this is down. And right here is 1970, 75, I would say, goes up, As action goes up and then it goes down. So the interest rate also goes down. And for the newest data right here, 2020-23, as you can see, the interest rate actually goes up, and which caused the inflation down. And then if the logic here is true, then the interest rate fall will be pretty much quickly. Now, to show you what I mean, I actually got the projected data directly from Federal Reserve Board. This is their data provided on December 2023 meeting. As you can see, most of the federal officials think the Federal Reserve rate should be around 4.5% in 2024. 2025, this should drop to 3.5%. 2026, 2.5%, and in longer run, it will stay in 2.5%, which shows exactly what I mean. The Federal Reserve is planning to drop the interest rate, which will make this investment a worth of consideration and possible. And here's the range of possible gain from this investment. Now, you may argue that the yield to maturity is not exactly same with the interest rate set by Federal Reserve. It is true, but if Federal Reserve decreased the interest rate, the yield to maturity of all related product will also drop. Maybe the drop may not be the same. For example, interest rate drop by 1%, this yield to maturity only drop by 0.5 or 0.7. It is possible. So let's say the Federal Reserve dropped the interest rate by 2.5%. And the yield to maturity, let's say, drop by 2%. And if they actually drop by 2%, you will actually have a gain around 78%. Or let's say you drop by, what about 1%? Drop by 1%, and you will have a gain around 33%. And this is extremely possible because, as you can see, they already have a plan for each of the following years, like year one right here, year two right here. It is all possible. So if the Federal Reserve actually decide to lower the interest rate back to 2.5 level, you maybe have a gain around here, 78% to 53%. Very profitable within 2 to 3 years. Now, here's the range of possible loss, which I think is not likely scenarios. Right here, if this kind of things happen, that must be the Federal Reserve decide to raise the interest rate again. And if they do that, that means the inflation is also up to a level between, I would say, maybe back to the 2023 level, such as we got 8%, 9%, 10% inflation again, and that will cause the Federal Reserve to raise the rate again. So in these scenarios, the yield to maturity actually goes up, and if that happens, your investment will have a huge loss. If the yield to maturity goes up by 1%, you will lose 25% of your portfolio. Goes up by 2%, you will lose 43% of your portfolio. The loss is also possible. But as long as the inflation and the interest rate is under the control of the Federal Reserve, this is unlikely scenarios. So the potential risk, like I discussed it previously, will be persistent inflation, and for some reason, the economy become extremely hot, cause the inflation to go up, and Federal Reserve have to act by raise the interest rate, and that will make our investment lose a lot of money. And increasing consumer spending will definitely make the inflation pressure much, much heavier, and will thus cause the interest rate to go up again. And shifting out to a Federal Reserve, we are only able to be certain how much the interest rate the Federal Reserve going to set. Is it going to be 0% for the last 10 years or the 5% in the 1990s? We are uncertain about that. But according to projection, they plan to set it to 2.5%. So should be fine. So in general, it is still uncertain how Federal Reserve will adjust the interest rate. But with given circumstances and current conditions, if the inflation is back to 2% goal that Federal Reserve desired, then this whole investment will work and make you a lot of money. Like I said, there is risk in everything we see and touch, but if the reward is higher than the risk, it is a risk worth taking. Thank you so much for your attention. And if you have any kind of question about this investment or the investment strategies, feel free to contact me with the email below. I'm more than happy to help you with anything you may concern.